All right, my friends, getting a lot of comments about bonds, and that scares me a little bit. A lot of people say, my bonds are up, I don't know, 10, 12, 15, 20%. Look, bonds are a fixed income. That means they cannot give you gains outside of the coupon you get. This, I cannot, I stated this a million times, I'll state it again and again and again. A bond is issued at $1,000. It has a 3% coupon. The bond matures at $1,000. Is literally how it works. You cannot get 9% returns when a bond is only paying a 3% coupon. It's impossible. But it give me a return. That's all. That's all short term. I guarantee I will guarantee you this. It's a fleeting return. If a bond is trading that much higher than its par value, it will go down in value. It has to. It's inevitable. Do not get suckered into this idea that bonds have given you 9, 10, whatever it is this year. It's fake. It's fleeting. Now, you could sell it and take a capital gain, sure, but you're not going to buy another bond with that capital gain without paying the premium too. I mean, just think about it. If you bought a bond for $1,000 and now it's trading at $1,100, all right, and you sell it because you had a 6-month gain of 10%, you're like, that's pretty good, all right? What are you going to do with the proceeds? You're going to have to buy another bond at $1,100 to get the same exact yield. There's just no two ways around this. It's literally that simple. And I'm not chastising people who don't get this. It's not, once you get it, you're like, oh man, it's so easy to get. But until you get it, it's tough because you're like, wait a second. Because you're so used to this idea of stocks with compounding interest. I get 9% or 10% or 11% or down 20%. And you're used to comparing bonds returns as if they're similar to stocks, then nothing could be further from the truth. The only benefit of bonds being up 9% is that you're getting out of it before you lose that capital appreciation. And that means you are giving yourself, it's a fake gain. But a fake gain is better than no gain for sure. But if you hold on to that bond, I guarantee you're going to lose that 9%. It's inevitable. You will have to let it go. And so it's gone up in value from where it was. It started here. It's gone up because interest rates on the cycle have gone down. So your bond that is out there today is worth a whole lot more than what it was just last year because interest rates have dropped. It doesn't change the fact that the bond will slowly go to maturity each and every year, and the closer you get to maturity, the quicker the capital loss will be. I hate to even say capital loss, but just the revert to mean. I mean, that's literally what it is. It's a reversion to mean. I mean, the mean is the price of the par value of the bond. Interest rates go down, the price of the bond goes up, but it will revert to mean. It's no other way around it. Interest rates go up, the price of the bonds goes down, but it will revert to mean, which mean in this case is the maturing value of the bond or the par value. You got to understand this. Don't get suckered into my bond. Now, again, bonds will give you a short-term up or down. But the question is, you own the bond for a reason. And so if you sell that bond to lock in a capital gain, you have to do something with the proceeds. And that something with the proceeds, well, it won't be used to buy another bond because you're going to give up that gain you had because the other bond is also trading at a premium. So if I have a $1,000 bond at a 3% coupon and you have a $1,000 bond at a 3% coupon, and now a year later the interest rates across the board go down to 2%, we both have $1,100 bonds at a 3% coupon. That's all there is to it. If I want to maintain my 3% yield and I sell my bond at $1,100, I have to buy your bond at $1,100 too. It's just the way it works, man. There's no two ways around that. There's no two ways around that, and that's what you have to do. And yet a lot of people get suckered. Now you can say, well, I bought my bonds as a offset to stocks. That's a different story. I got no qualm with that. I got no qualm with that at all. You buy your bonds to eliminate some of the volatility of the stock market, but then I just simply say just do the CDs, man. Because CDs are not quite as long-term, and CDs are FDIC insured, where bond and the CDs right now pay more, generally speaking. They certainly pay more than government bonds. They're within a spitting distance of corporate bonds. I haven't really looked at the corporate bond. I think I did look at the AA market. Yes, I forgot what it was, but it wasn't some. I don't think it was that much higher than CDs actually. So with CDs, you're getting we'll say a little bit less of a yield, but you are getting FDIC insurance. And corporate bonds, you might be getting a little bit more of a higher yield, but you're getting no guarantees. And so that bond could go kaput, as we've seen many times this Sunday. So I'd say, hey, look, if you want the safety or the diversification that bonds can offer you, well, go the CD route, in my opinion. I wouldn't mess with bonds. Just don't get suckered into this idea that your bonds have given you 9%. I had one guy email me that his bonds have averaged, I think it was 9% going back to 2000 or something like that. Yeah, that's why Wellington did so well relative to the stocks, because the bonds did fine. But it can't continue. I mean, I can't stress this anymore. When the interest rates on 10-year treasury is below 1.5, we'll just say the interest rates on corporate bonds will just say 3, you're not getting more than 3%. You're just not. On any given 6-month time, yeah, but you will lose that 9%. I'm just telling you right now, you will lose it. It's guaranteed. And the reason we know it's guaranteed because the bond will mature at a set price, which is lower than what it's worth right now. I have to go on the whiteboard and show it to you again, because I'm going to do this time and again until I'm blue in the face, so everyone understands how bonds work. Bonds have a guaranteed rate of return. It's fixed. You're not getting more, you're not getting less, unless the bond goes bankrupt, and then you will get less. And that's it. Any gain that is more than that will be gone. There's no getting around that. All right, we'll see you.